Hi, Jeff Andrews here, financial advisor with Harmon Advisors. Today we're going to talk about stocks versus bonds versus mutual funds. So when you hear the term stock, think ownership. So if you buy a share of stock in ABC Company, you're literally part owner of ABC Company. And so just like as if you were to open a business in the mall down the street, however that business goes, that's how your investment goes. So let's say ABC Company's profits are up 20 or 25%. Well, you might find your stock value up 20 or 25%. Conversely, if their profits are down 20 or 25%, you might find that your stock value is down 20 or 25%. Remember, with the stock, as an owner, however the company goes, that's how your investment goes. Now with a bond, when you hear the term bond, think loan. And so like any loan, where you're essentially just loaning money to ABC Company. And so like any loan, there's an interest rate and a term. And so for our example, let's say that you buy a bond from ABC Company and the interest rate is 5% and the term is 10 years. So each year, ABC Company is going to pay you 5% interest. And then at the end of 10 years, they're going to give you your principal back. Now, when you think about the volatility though, and how it behaves versus a stock, so if ABC Company's profits are up 20, 25%, well, they only owe you 5% interest. But conversely, if ABC Company's profits are down 20 or 25%, well, they still owe you the 5% interest as a bondholder. And so in that way, bonds have much less downside risk to them than stocks. Now, where the real difference really comes in is in that overall volatility characteristics. Stocks give you that long-term upside to your portfolio, and bonds kind of act like a shock absorber to reduce the overall volatility in the portfolio. Because when people are selling their stocks and money's coming out of the stock market, it doesn't just go under mattresses all over the country. What it does is it goes over into the bonds. And so while the stock side of your portfolio may be going down in value, that bond side is actually starting to go up because all of a sudden that 5% interest looks really, really good when you've got your stocks going down 10, 15, 20%. So what's a mutual fund? Well, let's say that you have $1,000 to invest, and let's say for the sake of our discussion, ABC stock is trading at $150 a share. Well, you'd only be able to buy about 6 shares of stock in ABC Company, and that's hardly a well-diversified portfolio. And in fact, your performance is going to be tied entirely to however ABC Company does. So if ABC Company's profits are down 20 or 25%, well, your entire investment's going to be down. And even worse, if ABC Company had to declare bankruptcy, you might find that you lost your entire investment. But with a mutual fund, what they're going to do is it's going to take your $1,000, my $1,000, and lots of other people's $1,000 and pool it together so they have billions of dollars. Then they can buy lots of stock in lots of different companies and essentially spread your risk around. So if ABC Company is not performing very well, or heaven forbid that it went bankrupt, well, it's only one of maybe 100, 200, or in the case of an S&P 500 mutual fund, 500 companies that's in your investment portfolio for that same $1,000. And so what a mutual fund does is it gives you the ability to spread that risk around for smaller amounts of money. It also actually gives you access to professional money management and can give particularly US investors access to asset classes that maybe we wouldn't otherwise have access to. Things like emerging markets or real estate or even commodities. So thank you everybody. That's the difference between stocks and bonds and mutual funds. If you have a question on another financial topic, you can send us a note by visiting our website, harmonstreet.com. We also have a variety of educational resources and tools on the website to help you make great financial decisions. Again, I'm Jeff Andrews, financial advisor for Harmon Advisors, reminding you, don't have a car payment, take your lunch to work.